There is a number buried inside the Social Security Administration's own actuarial tables that the IRS has never once sent you a letter about, never once flagged on your return, never once highlighted in any publication they mailed to your house. That number is $187,000. That is the approximate additional lifetime federal tax exposure the average retiree creates for themselves, silently, permanently, irreversibly, the moment they file for Social Security at 62. Not because they did anything wrong, not because they cheated, because they filed early, triggered a lower benefit permanently, and then spent the next 25 years pulling more money from their IRA and 401k to make up the gap. And every single dollar of that gap gets taxed. The IRS does not need to send you a letter. You already signed up for the arrangement yourself. Meanwhile, there are retirees collecting $2,200 a month in Social Security instead of $1,400. Same earnings record, same work history, same person, paying less in federal income tax per year because more of their income comes from a source that gets favorable tax treatment, and less of it comes from taxable retirement accounts getting drained at the worst possible time. Today, I am going to show you exactly what filing at 62 does to your tax bill. Not in theory, in actual dollars. I am going to show you the 3 hidden IRS mechanisms that punish early filers for the rest of their lives. I am going to show you the real break-even math that the Social Security Administration's own website glosses over. And I am going to show you what the smartest retirees are doing right now in 2026 in a down market that turns this entire situation into a tax advantage most people will never see. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Alex Bones. Every week I break down the tax rules, the financial traps, and the retirement strategies that protect your money from the things nobody else is explaining. If that sounds like something you need, hit subscribe right now and turn on notifications. Let's get into it. When you walk into the Social Security office, or more likely when you go online and fill out the form at 62, they show you one number, your monthly benefit. Let's say it's $1,400 a month. What they do not show you is your benefit at 67, which might be $2,000, or your benefit at 70, which might be $2,180. The difference between $1,400 and $2,180 is $1,180 a month. That is $12,960 a year. That is real money. But the Social Security Administration frames it as a trade-off. You get money earlier, you get less per month, it evens out around your break-even age. Here's what they never show you. The tax math underneath the monthly benefit math, because it is not just about how much Social Security you collect. It is about what you have to do with the rest of your money to survive while you're collecting less. And what you have to do with the rest of your money is the part that the IRS is watching very carefully. Let me give you a real example. Meet David and Carol, both 62. David has a pension of $28,000 a year. Carol has no pension. They have $480,000 in a traditional IRA. They need $72,000 a year total to live comfortably. Scenario A, they file at 62. David's Social Security, $1,380 a month. Carol's Social Security, $940 a month. Combined, $2,120 a month, $27,140 a year, plus David's pension, $28,000. Total guaranteed income, $55,840. Gap to reach $72,000, $16,160. That gap comes from the IRA every single year. Scenario B, they wait until 67. David's Social Security, $1,970 a month. Carol's Social Security, $1,340 a month. Combined, $3,310 a month. $39,120 a year. Plus David's pension, $28,000. Total guaranteed income, $67,120. Gap to reach $72,000, $4,280. That gap comes from the IRA. Same income, same lifestyle, same house. But in scenario A, they are pulling $16,160 from the IRA every year. In scenario B, they are pulling $4,280. Over the 5 years between 62 and 67, the years they waited in scenario B, they pulled $80,800 less from the IRA in total than they would have under scenario A. That $80,800 stayed in the account. It kept growing. And they never paid income tax on it during those years. That is, before we even get to what happens to the tax bill. That is just the math on the withdrawals. Here is where it gets serious. There are 3 specific IRS mechanisms that work against early Social Security filers. Most people know about none of them. Some people know about one. Very few people understand how all 3 interact with each other at the same time. Mechanism number 1, the provisional income trap. The IRS does not tax your Social Security benefit in isolation. It looks at something called provisional income. That is your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefit. If that number exceeds $32,000 for a married couple, up to 50% of your Social Security benefit becomes taxable. If it exceeds $44,000, up to 85% of your Social Security becomes taxable. Now here is the trap. When you file early and your benefit is low, say $27,840 combined for David and Carol, you are pulling more from the IRA to make up the gap. That IRA withdrawal pushes your provisional income up, which makes more of your Social Security taxable, which raises your effective tax rate, which means you are getting taxed more on the Social Security and more on the IRA withdrawal at the same time. You did not create two tax problems. You created one tax problem that multiplied into two. If David and Carol file at 62, pull $16,160 from the IRA, and collect $27,140 in Social Security, their provisional income is approximately $57,920. That is well above $44,000. Up to 85% of their Social Security is now taxable. Their federal income tax bill is approximately $6,200 a year. If they wait to 67, pull only $4,280 from the IRA, and collect $39,720 in Social Security, their provisional income is approximately $51,120. Still above $44,000, but barely. And with a lower IRA withdrawal, their actual taxable income is lower. Their federal income tax bill drops to approximately $4,100 a year. That is $2,100 a year in additional federal income tax, every year, for the rest of their lives, just because they filed 5 years earlier. Over a 20-year retirement, that is $42,000 in additional federal income tax and each on the same income. Not because of tax rates changing, not because of new laws, because of when they filed. Mechanism number 2, Medicare IRMA surcharges. Most people have no idea this exists until they get the letter. IRMA, the Income-Related Monthly Adjustment Amount, is the Medicare premium surcharge the federal government charges you when your income crosses certain thresholds. In 2026, if your modified adjusted gross income as a married couple exceeds $212,000, your Medicare Part B premium jumps from $185 a month per person to $259 a month per person. That is an extra $888 a year per person, $1,676 a year for a couple. Now you're thinking, David and Carol are not making $212,000. They're fine. Here is where it gets dangerous. IRMA is based on your income from 2 years ago. So when you turn 63 and your Medicare kicks in, they're looking at your income from 61. And if at 61 you were doing a Roth conversion, trying to be smart, trying to move money out of the traditional IRA before RMDs hit, and that conversion pushed your income above the threshold, you are now paying IRMA surcharges at 63 because of what you did at 61. Without a single warning, early filers who try to compensate for low Social Security income by accelerating Roth conversions in their early 60s often trigger IRMA surcharges they never saw coming. And the surcharges last a full year with a 2-year look-back. One bad income year costs you 2 years of elevated Medicare premiums. Mechanism number 3, the RMD acceleration bomb. This is the one that truly costs people the most money and the one almost nobody connects back to the age 62 filing decision. Required minimum distributions, RMDs, kick in at age 73 under current law. The IRS requires you to take a percentage of your traditional IRA balance every year starting at 73, whether you need the money or not. And every dollar of that RMD is taxable income. The size of your RMD depends on the size of your IRA balance at the end of the previous year. Bigger balance equals bigger RMD. Bigger RMD equals more taxable income. More taxable income at 73 potentially means more of your Social Security taxable. Potentially means IRMA surcharges. Potentially means a higher Medicare premium on top of a higher tax bill. Now connect it back. David and Carol file at 62. They pull $16,160 from the IRA every year for 5 years. That is $8,800 in early withdrawals. But because they are in their early 60s, they are also missing 5 years of IRA growth on a higher balance. In scenario B, where they wait to 67, they pull only $4,280 a year, $21,400 over 5 years, and the extra $59,400 that stayed in the account kept compounding. At a conservative 5% annual return, that difference in IRA balance by age 67 is not $59,400, it is closer to $74,000. Because the money that stayed in the account was growing while theirs was being withdrawn. By the time they hit 73, the IRA balance gap between the two scenarios is significant. The early filer has a smaller IRA. That sounds good until you realize a smaller IRA does not mean smaller RMDs proportionally. The IRS's RMD percentage goes up as you age. And they may have also locked in a smaller Social Security benefit that does not cover expenses as well at 80 and 85 when costs go up. The early filer ends up with 3 problems hitting simultaneously at 73. a smaller Social Security check, a depleted IRA, and RMDs that push their tax bill higher than expected anyway, just from a smaller account with less flexibility. 3 problems, 1 decision, made at 62. Let me address the break-even argument directly because you've heard it, and it sounds reasonable. The argument goes like this. If you file at 62 instead of 67, you collect 5 extra years of checks. Even though each check is smaller, you're ahead until your break-even age, usually somewhere around 78 or 79. If you die before that, you won. If you live past it, you lose. So it's a coin flip based on longevity. That sounds logical. It is also incomplete in 3 specific ways. First, it ignores the tax drag on early payments. The checks you collect at 62, 63, 64, 65, 66 are not free money. They are income. They are added to your provisional income calculation. And if they push 85% of your benefit into the taxable column, you are not collecting your full early payment. You are collecting that payment minus the additional federal income tax it triggers on itself and on your other income. The break-even calculator on the SSA website does not account for this. It just adds up gross checks. Second, it ignores what you do with the money. The break-even math assumes you are investing every early Social Security check at a market rate of return and letting it compound. Most retirees are not doing that. They are spending it. It is covering groceries and utilities and car payments. You cannot invest money you needed to live on. So, the theoretical investment return that makes the early filing look competitive on paper does not exist in most real households. Third, it ignores longevity risk at the worst possible time. The average 62-year-old American today has a life expectancy of approximately 84 for men and 86 for women. That is averages. Half of all 62-year-old couples have at least one spouse who lives past 90. If you live to 90, filing at 62 versus 67 costs you $324,000 in lifetime Social Security income. On Carol and David's numbers. If you live to 92, it costs $349,000. The break-even argument treats dying before 79 as winning. Most retirees, especially healthy ones who are actively planning, are not going to die before 79. They are going to live to 84, 87, 91. And every year past that break-even point, the early filer is collecting $12,960 less per year than they would have if they waited. $349,000 gone because of a decision made on a website at 62 in about 15 minutes. Here is what is different in 2026 that makes this conversation more urgent than it has ever been. The $6,000 senior bonus deduction. The One Big Beautiful Bill created a brand new $6,000 federal deduction for Americans 65 and older with modified adjusted gross income under $75,000 single or $150,000 joint. That is $12,000 for a couple where both spouses qualify. This is new. It did not exist before 2025, and it interacts directly with the Social Security taxation question. Here is how. If you are 65, collecting Social Security, and your income is below $150,000 joint, which covers the vast majority of middle-income retirees, you now have an additional $12,000 of deductions, reducing your federal taxable income. That means your provisional income threshold situation just got slightly more favorable for people waiting to 67. The gap between the early filer's tax bill and the delayed filer's tax bill just got wider in 2026, not narrower. The tariff-driven market drop. Right now, retirement accounts are down. Some are down 15%, some are down 20%. If your IRA is down and you have not filed for Social Security yet, this is one of the most favorable windows in years to execute a Roth conversion. Here is why. When you convert traditional IRA money to a Roth IRA, you pay income tax on the converted amount in the year of conversion. If your IRA is down 18%, you are paying income tax on 18% less money than you would have paid 6 months ago. And all future growth in the Roth, which is entirely tax-free, happens from this lower baseline, but here's the connection back to Social Security. A Roth conversion done in your early 60s reduces your future traditional IRA balance. A smaller traditional IRA balance means smaller future RMDs. Smaller RMDs at 73 mean less forced taxable income. Less forced taxable income means more of your Social Security stays below the 85% taxation threshold. It means potentially avoiding IRMAA surcharges. It means a lower federal tax bill for the rest of your life. The people who benefit most from this Roth conversion window are the people who have not yet filed for Social Security, because they have not yet locked in a low benefit. They still have the flexibility. They can convert during a down market, They can reduce RMDs. They can control their provisional income at 73 and 74 and 75. They can reduce their lifetime tax bill by doing smart things now. The people who filed at 62, they locked in the low benefit. They've been spending down the IRA for years. The Roth conversion window is less powerful for them because the IRA is already smaller and the Social Security is already locked in low and the tax trajectory is already baked in. The SALT cap change. The state and local tax deduction cap jumped from $10,000 to $4,400 in 2026. For retirees in high property tax states who itemize, New Jersey, New York, Connecticut, Illinois, this is significant. If you were taking the standard deduction because itemizing did not clear the threshold, run the numbers again. The math may have flipped, and if itemizing now makes sense, it reduces your federal taxable income further, which interacts with your provisional income calculation and reduces the amount of Social Security being taxed. Part 5. When filing. At 62 is actually the right answer. I am not going to pretend this is a simple decision for every single person watching this. There are legitimate situations where filing at 62 is the correct choice, and I will give you the honest version. Situation 1, you have a serious health condition. If your doctor has told you that your life expectancy is significantly shorter than average, we're talking a diagnosed condition, not general pessimism, then the break-even math shifts. If you have a reasonable expectation of not surviving to 78 or 79, taking the early benefit is financially rational. This is the one situation where the break-even argument holds completely. Situation 2, you have zero other income and you need the money. If you are 62, you have no pension, your savings are depleted, and you cannot work, you file. You take what you can get. There is no shame in that. The tax optimization conversation only matters if you have options. If you have no options, Social Security at 62 is a lifeline, not a tax decision. Situation 3. Your spouse has a significantly higher earnings record and will delay. In this scenario, filing for the lower earner's benefit at 62 while the higher earner delays to 70 can make sense. The higher earner's delayed benefit becomes the survivor benefit when one spouse dies. The lower earner collects something now. It requires careful modeling, but it is a legitimate strategy, not a mistake. Outside of those three situations, for a healthy 62-year-old with savings, a pension, an IRA, and options, filing at 62 is almost always the most expensive financial decision of the entire retirement. Here is the playbook that the retirees nobody ever writes articles about are quietly executing while everyone else is rushing to file at 62. Step 1. Bridge the income gap with the IRA strategically. Instead of filing at 62 and collecting a small benefit forever, they delay Social Security and use IRA withdrawals to bridge the gap between 62 and 67 or 70. Yes, they are pulling from the IRA, but they are pulling at a controlled rate, and they are timing those withdrawals to stay below the provisional income thresholds. They are managing how much of their Social Security gets taxed before they even file. Step 2. Execute Roth conversions during the bridge years. While they are living on a combination of IRA withdrawals and whatever other income they have, they are simultaneously converting chunks of the traditional IRA to Roth. They are filling up the 12% and 22% tax brackets deliberately. Every dollar they convert now is a dollar that will never create an RMD at 73. Every dollar in the Roth grows tax-free forever. This year, 2026, and with markets down, that conversion costs 15 to 20% less in tax than it did a year ago on the same number of shares. That is a direct dollar savings on the conversion itself.